Welcome back to the Deep Dive. It is November 2nd, 2025. Today we're kicking off with a really deep look into a company that, well, it really captures this modern growth paradox, explosive user numbers, but also equally explosive spending. We call this Deep Dive, a deep dive into U.S. stocks, exploring Roblox. Our focus today is Roblox Corporation, ticker RBLX.
Yeah, this is perfect timing, actually. Roblox just put out their Q3 2025 earnings, and honestly, the results have kind of thrown investors for a loop.
How so?
Well, you're seeing absolutely historic user growth. I mean, numbers that should scream massive success. But the stock actually tumbled after the announcement.
Really? Why?
It seems to be down to the persistent net losses and these huge spending commitments they're flagging for the future, a lot of it driven by, regulatory pressures and tech investments.
Okay, so that's our mission today then. We want to give you, the listener, the full context here. We need to really unpack those Q3 financials, look at the analyst ratings, which seem to be all over the place, and understand this fundamental tension.
Exactly. How can a platform with this much activity, this much engagement, still be unprofitable on a GAAP basis?
Right. And what is all this necessary spending on infrastructure, safety, AI? What does it actually mean for the company's future valuation?
Yeah.
We're trying to balance that, high-growth stock narrative against the sobering reality of these rising costs.
Let's get into it.
Okay, first things first, before we even touch the financials. What exactly is Roblox?
Yeah, that's crucial, because just calling it a gaming company really misses the mark. Roblox sees itself as much more than that. It's framed as like a fully immersive digital platform for connection, for communication. It operates globally. And yeah, gaming is a big part of it, but it's just one use case among potentially many others they envision.
It sounds a really ambitious vision. Management keeps talking about this grand plan, right?
They do. They talk about fundamentally reimagining how people come together online. They want a digital world that's safe, civil, and they always add this, optimistic.
So they're not just competing with other games, they're competing for people's social time.
That's exactly how they frame it. And they've put a number on it, too. Their stated market goal is huge.
Which is?
They're aiming to capture 10% of the entire global gaming content market.
Wow. How big is that market estimated to be?
Currently around $180 billion. So 10%. That's an $18 billion target they're shooting for.
Okay, so if you accept that kind of ambition, then maybe the heavy investment strategy starts to make a bit more sense.
Right. You spend big now to try and secure that massive slice of the pie later.
So how do they actually make this happen? The core seems to be this user-generated content model, UGC.
Precisely. That's the absolute foundation. Roblox itself doesn't create the vast majority of the experiences on its platform.
They provide the tools, basically.
Exactly. They provide the toolbox, the platform, and crucially, the audience. They're community developers, creators. They build the actual experiences.
And that's what drives users in.
Yes, and that engagement leads to transactions using Robux, their in-platform digital currency. It fuels this whole creator economy.
It sounds like a network effect.
A classic one. More creators mean more varied content, which attracts more users, which then incentivizes more creators to join. It's a self-reinforcing loop, ideally.
Okay, and this reliance on Robux, this digital currency, brings us to something that always seems to confuse people in their earnings reports. The difference between bookings and revenue. We really need to nail this down.
Yeah, this is probably the single most important accounting point for anyone looking at Roblox. So bookings in Q3 2025 were huge, $1.92 billion.
And bookings means?
That's the cash they actually collected. It represents the sales activity, like when a user buys a stash of Robux.
Got it. So if I go on today and buy, say, $100 worth of Roblox counts that $100 immediately as a booking for this quarter.
Correct. That $100 is booked right away. Now, revenue, that's different.
Which was $1.36 billion in Q3, so lower than bookings.
Right. Revenue is the amount that Roblox is allowed to recognize on its official income statement, its GAAP statement, over time.
Why over time?
Because that Robux you bought, you might spend it tomorrow or next month, or even spread it out over a year or more on different things. So accounting rules say they can't recognize all that cash as revenue immediately. They have to spread it out.
Spread it out based on what?
Based on the estimated average lifetime of a paying user. As of Q3 2025, they calculated that average lifetime to be 27 months.
27 months. Okay, so my $100 booking.
They'd recognize roughly $3.70 of that each month as revenue for the next 27 months.
Okay, so the cash is in their bank account straight away.
Yes, which is why their cash flow often looks strong.
But the official revenue number on the income statement gets dripped out slowly over more than 2 years.
Exactly. That deferral mechanism is absolutely critical to understanding their financials.
And that leads right back to the paradox, doesn't it? Because while that revenue is recognized slowly over 27 months,
Their costs aren't.
right, things like building data centers, paying moderators, R&D, those costs are often recognized immediately in the quarter they happen.
Precisely. When your cash inflow, the revenue side, is lagged, but your strategic spending, the costs, are upfront, well, you almost guarantee a GAAP net loss during periods of really fast growth.
Even if the underlying business is generating lots of actual cash.
Exactly. It's like, imagine a gym selling a 3-year membership upfront. They get the cash now, but they can only report the revenue monthly. If they're also building a new swimming pool that year, the income statement might look rough short term.
Okay, that's a really helpful way to think about it. Keep that tension in mind as we move on.
We have to.
All right, let's pivot to the sheer scale, the momentum. Because the Q3 results they announced on October 30th, the growth was, well, pretty staggering. It blew past what analysts were expecting.
It did more than that. Management actually came out and said these results put them at least 2 years ahead of their own long-term guidance schedule.
2 years ahead, wow.
Yeah, the one they issued back in late 2023. That's incredible acceleration.
So what were the headline numbers driving that?
Revenue for Q3 hit $1.36 billion. That's up a very strong 48% year over year.
Okay, 48% is solid. But wasn't bookings the real shocker?
That was the jaw dropper. $1.92 billion in bookings. That's up a massive 70% compared to Q3 last year. It just crushed the consensus estimates, which were around $1.65 billion.
70% growth in bookings. Where is that coming from?
It's purely scale and engagement. Look at the user numbers. Daily active users, DAUs, they soared 70% year over year.
How many DAUs are we talking about?
151.5 million daily active users.
150 million.
Yeah.
Every day. That's huge. That's bigger than some countries.
It's massive. And these users aren't just logging in and leaving. They're spending serious time there.
Engagement metrics.
Hours engaged jumped an astonishing 91% year over year.
91%.
Yep. Reaching 39.6 billion hours spent on the platform in a single quarter.
Almost 40 billion hours. It's like a digital nation, as you said, built on this user content.
And that content can go incredibly viral very quickly. The outline mentions some recent hits. Grow a Garden apparently hit nearly 22 million concurrent players back in July.
22 million people playing the same user-made game at the same time.
And then more recently, another one, Steal a Brain Rot,
Yeah.
supposedly eclipsed 25 million concurrent players just last month in October.
Okay, we should pause on Steal a Brain Rot.
Mm-hmm.
For anyone listening who isn't deeply immersed in internet slang, brain rot usually refers to that kind of low-effort, super addictive, maybe repetitive online content.
Yeah, the kind that just hooks you for quick engagement hits.
Right. The fact that a single Roblox experience, presumably tapping into that kind of meme or style, can pull in 25 million people simultaneously, that says a lot about the platform's flexibility.
It really shows the power of the UGC model. They can instantly jump on a fleeting internet trend without needing Roblox corporate to greenlight a development cycle.
No internal studio needed.
Exactly. And this sheer scale, this viral potential, is what gets institutions like Morgan Stanley really excited.
What are they saying?
They're maintaining a really bullish view. They explicitly compare Roblox to other huge UGC success stories, like YouTube.
Interesting comparison.
Their bull case valuation for Roblox goes as high as $300 a share. They see a clear path, they say, to Roblox surpassing 1 billion users by 2030.
A billion users. Wow.
They're essentially betting that the network effects and the sheer scale will inevitably lead to massive long-term monetization, even if it's bumpy now.
And part of that long-term bet must be the changing user base, right?
Yeah.
It's not just for little kids anymore.
Absolutely not. That narrative is outdated. The platform is definitely aging up, as they say.
Is the data clear on that?
Oh, yeah. The fastest growing segment by far is users aged 13 and up.
How fast are they growing?
That group saw an 89% year-over-year increase in DAUs.
89%. That's huge. And crucial, I guess, because older users generally have more money to spend.
Exactly. More disposable income. And they're also the demographic that advertisers and brands want to reach when they launch their own experiences on Roblox.
And it's not just aging up, it's also going global, fast.
Very fast. DAUs outside the US and Canada surged 81% year over year. The Asia-Pacific region, APAC, is particularly strong.
Any specific country standing out?
Indonesia is the poster child right now.
Yeah.
Bookings there increased, get this, 804% year over year.
800%.
How? It wasn't luck. It's attributed directly to specific strategies, like introducing regional pricing, making Robux more affordable, basically, in markets with lower average purchasing power.
So they're successfully growing the paying user base globally by adapting their prices.
Yes. It confirms that strategy of securing the ecosystem users now, even if these new international users might spend less initially than someone in North America, capture the user first, monetize more later.
Okay, so the top-line growth is undeniable. Users, engagement, bookings, all exploding upwards, ahead of schedule, aging up, globalizing. It sounds like a perfect story.
It sounds like it.
But when we come back to that stock drop,
Yeah.
why did it tumble 10% after announcing all that good news?
Fear. Pure fear about the costs and the margins.
So the market completely ignored the 70% bookings growth.
It seems like it, yeah. They focused instead on the fact that the official GAAP net loss actually got slightly worse. It widened a bit in Q3 to $257.4 million.
Compared to what loss last year?
$240.4 million loss in Q3 2024. So, more sales, slightly bigger loss on paper. That narrative really spooks investors who are just looking at PE ratios right now.
And that feeds those analyst red flags you sometimes see: negative earnings, negative margins.
Right. But again, this isn't an accident. This is an explicit strategic choice by management. They are choosing to prioritize long-term platform health, safety, and growth over delivering short-term GAAP profits.
And we can see that choice reflected in their spending plans.
Oh, absolutely. Look at capital expenditures, CapEx. They massively increased their guidance for the full year.
How much?
They added an extra $158 million to the CapEx forecast. That pushes the total expected spend for the year up to $468 million.
Almost $500 million in CapEx.
Yep. And this isn't just, routine server upgrades. This is a major infrastructure build-out, an arms race, almost.
Okay, let's break that down. Why the $468 million surge? Management said it's to keep up with growth. What does that physically entail?
It means more servers, bigger data centers, better network connectivity. When your daily users jump 70% and the hours they spend jumps 91%, the demand on your physical computing infrastructure just explodes.
So they're spending to handle the current load and reduce lag for all those new global users.
That's a big part of it. But it's also about investing in the next phase. Specifically, buying the hardware needed for their big push into AI.
Ah, okay. And this spending is significant enough that it affects future profit outlooks.
Yes. They proactively warned investors that operating margins might actually dip slightly year over year in 2026.
Why?
Because this big wave of infrastructure and safety spending is sort of catching up or hitting the books, while the revenue from all the new bookings is still being recognized slowly over that 27-month period. The costs hit now, the revenue comes later.
Okay, so that's fixed infrastructure costs rising. What about the variable costs? The costs related to the creators themselves?
Also rising rapidly, payments to developers, what they call developer exchange fees, or DevEx, they jumped 85% year over year.
How much did they pay out in Q3?
$427.9 million, almost $500 million flowing directly to creators in just 3 months.
Wow. And wasn't there a recent change to how much they pay creators?
Yes, and this was Roblox choosing to increase costs. On September 5th, they officially raised the DevEx rate by 8.5%.
So they're paying creators more per 1,000 Robux earned.
Exactly. It went from $3.50 to $3.80 per 1,000. It's an aggressive move to keep top talent happy and building on Roblox, rather than, say, jumping to Unreal Engine or just making mobile apps.
Competing for the best content.
Right. But it's costly. DevEx now eats up about 31.5% of their total recognized revenue.
Okay, so rising fixed costs with CapEx, rising variable costs with DevEx. What else?
Then you have just the operational costs of running such a huge platform. Infrastructure and trust and safety expenses together grew 61% year over year to $208.2 million.
Then that's mostly.
Just keeping the lights on, servers running, paying for moderation, keeping the platform secure for over 150 million daily users. A big chunk of that $208 million is payments to third-party cloud providers.
For handling those peak loads, you mentioned over 45 million concurrent users.
Exactly. You need that elastic cloud capacity for those massive peaks, and it's expensive. But they're trying to change that, which ties back to the CapEx surge.
How so? This is the AI part.
This is the big AI bet. They're investing heavily in AI, not just for moderation, but for creation tools. They call it 4D creation.
4D creation. What does that mean?
Think AI tools that help creators build not just static 3D models, but objects and environments that are functional, interactive, and maybe even have behaviors. The idea is to drastically lower the barrier to making cool stuff, which should boost the UGC model even more.
Okay, that sounds potentially powerful. But developing and running that kind of AI, that requires serious computing power, right? Specialized hardware.
Exactly. GPUs, graphics processing units, the things you need for heavy AI training and running the AI models inference. And this is a core part of that CapEx increase.
So they're buying their own GPUs.
Yes. Roblox is planning to deploy GPUs at scale in their own data centers. They want to move some of those complex AI workloads off expensive third-party clouds and bring them in-house.
For long-term cost savings.
That's the goal. But the upfront investment in all those GPUs is massive. And management was very clear. This AI investment, both the CapEx and running these workloads, is expected to, quote, dilute near-term cost reduction opportunities.
Translation. It's going to hurt profits now for potential gains later.
Precisely. They are choosing future potential over current profitability numbers.
And layering on top of all this strategic spending, you have external pressures forcing their hand, especially around safety and regulation.
Yeah, the regulatory overhang is pretty significant and maybe unique to Roblox because of its historically younger user base. It's always been under scrutiny, but things really escalated recently.
Ow.
The Florida Attorney General launched a criminal investigation, not civil, criminal, focusing specifically on their safety practices, how they moderate content, and how they verify ages.
A criminal investigation, that's serious.
It sets a worrying precedent, not just for Roblox, but maybe for other platforms too. And alongside that, the legal risk is climbing.
Lawsuits.
We're hearing that law firms are gearing up to file potentially hundreds of lawsuits. Some estimates suggest over 1,000 cases could be filed by next year, mostly alleging things like child exploitation or grooming on the platform.
That sounds like a potential nightmare, both financially and reputationally. They have to respond, regardless of cost.
They do, and they are. Management says they're committed to setting the gold standard for safety, which means spending heavily on preemptive measures.
Like what?
For example, they've committed that by early next year, Q1 2026, anyone using communication features will need to use facial estimation technology.
Facial estimation? Wow.
Yeah. And they're also putting much stricter limits on communication between adults and minors who don't already know each other.
That seems necessary, but I imagine some users won't like those friction points. Did they acknowledge that?
He did, very explicitly. Management conceded that these stricter safety policies might actually hurt platform engagement in the short term.
So they're willing to potentially lose some users or engagement now to build trust and satisfy regulators long term.
It seems so. It's a clear signal they see safety and compliance as absolutely fundamental to being allowed to operate and grow over the next decade. It's a cost of doing business at their scale.
Okay, let's look at a couple of other maybe smaller warning signs that might have contributed to that post-earnings stock drop. Bookings were great overall, but wasn't there a miss on one specific metric?
Yes. Bookings per daily active user, or BDAU, it came in at $12.68.
Oh, sounds okay, but
It missed the expectation, which was around $13.24 according to Street Account. It's not a huge miss, but it signals something important.
which is?
That while the user base is rocketing up 70%, the average spending per user isn't quite keeping pace.
And why might that be?
It's likely a direct consequence of that rapid globalization we talked about. You bring in millions of new users from places like Southeast Asia where average spending is lower.
Like the 804% growth in Indonesia.
Exactly. If those new users spend, say, $5 a month on average, while your established U.S. users spend $20, the overall average, the BDAU, gets pulled down or diluted.
Even if total bookings are soaring.
Got it. And was there also some softness seen in their more established markets?
Yeah, one analyst, Corey Barrett, flagged that. He noted seeing a sharp slowdown in bookings growth in core European markets and the U.S. right around early October.
Why that? He put it down to a rationalization of growth as things return to normal after the summer, kids going back to school, that sort of thing. So you have maybe slowing growth in the high-spending markets, while the hyper-growth is coming from lower-spending international markets. That contributes to the BDAU pressure.
Anything else worrying investors?
Well, this is more anecdotal, but there were reports of notable insider selling after the Q3 results came out.
Executives or board members selling stock.
Yeah. And while there can be many reasons for that, it's rarely seen as a confidence booster by the market, especially when spending concerns are already high.
Okay, so let's pull that together. The market reaction, that 10% pre-market drop, it wasn't about the headline growth, which was amazing.
No, it seems the market completely fixated on the negatives or the potential negatives.
The huge CapEx guidance increase, the warning about margins potentially dipping in 2026, the slight miss on BDAU, maybe softness in core markets, the regulatory storm clouds, the insider selling.
That combination seems to have spooked the market enough to overshadow the 70% bookings growth.
But there's a huge counterpoint to all this gloom about costs and gap losses, right?
There is, and it goes back to that bookings versus revenue distinction, the cash.
Cash flow. How did that look in Q3?
It looked incredibly strong. Operating cash flow grew 121% year over year.
121% growth. To how much?
$546.2 million generated in operating cash in just the third quarter.
Wow. And free cash flow after basic maintenance CapEx.
Also very strong. Free cash flow grew 103% year over year to $442.6 million.
So despite the GAAP net loss, they generated almost $500 million in actual free cash in Q3.
Exactly. This shows the underlying business is generating a ton of liquidity. Management even felt confident enough to project that free cash flow growth will meaningfully exceed bookings growth in 2026.
And it's this massive cash generation that allows them to fund everything else.
Absolutely. It provides the war chest to pay for that $468 million CapEx plan, to cover the rising DevEx payments to creators, all without totally crippling their balance sheet. They're funding future growth ambitions with the cash the platform is generating today, even while reporting those GAAP losses.
That's a critical piece of the puzzle. So how does Wall Street put all this together? You've got world-beating growth and cash flow on one side.
And widening GAAP losses, huge spending commitments, and serious regulatory risks on the other.
It sounds like a recipe for disagreement among analysts.
It definitely is. The overall consensus rating from about 32 analysts is currently a moderate buy.
Okay, moderate buy. How does that break down?
It's roughly 21 buy ratings, 8 holds, and 3 sells. So generally positive, leaning towards believing in the long-term story, but those hold and sell ratings show there's real skepticism out there about the path to profitability.
And the price targets must reflect that uncertainty too. What's the average target?
The consensus 12-month target is around $130.68, which from the recent price, around $130, suggests about 15% upside. Sounds fairly reasonable.
Oh.
But the range of those targets tells the real story. It goes from a low of just $34.
$34.
Yeah, presumably from analysts laser-focused on the immediate margin hit and the risks, all the way up to a high of $180.
Wow, $34 to $180. That's an enormous spread for a big tech stock.
It screams fundamental disagreement. Wall Street just cannot agree on whether this massive CapEx and safety spending is a temporary investment phase or if it represents a permanent hit to the company's long-term profit potential.
What did specific banks do after the Q3 earnings? Who's in the $180 camp?
Goldman Sachs made a big statement. They upgraded the stock to buy and set that high $180 target. They're clearly betting that 70% bookings growth outweighs any near-term profit concern.
And Morgan Stanley, you mentioned them earlier.
They maintained their bullish overweight rating, kept their target at $170, and basically doubled down, calling Roblox a clear leader in whatever the metaverse evolves into.
Okay, so strong bulls. But not everyone was quite so optimistic.
No. JP Morgan, for instance, they kept their buy rating, but they trimmed their price target slightly from $160 down to $145. That signals they're maybe factoring in a bit more of that margin pressure from DevEx and safety costs.
And what about the holds?
Barclays is interesting. They kept their hold rating, but they dramatically increased their price target from just $40 all the way up to $130.
Oh, from $40 to $130, but still a hold.
Exactly. It shows they absolutely recognize the huge improvement in scale and cash flow, but the hold rating means they're still waiting for proof that management can actually get costs under control before they recommend buying it. They're wrestling with that core question. Can the growth eventually outrun the spending?
It really captures the dilemma. But despite this analyst debate and the stock's volatility, what about the big money? The institutional investors, are they sticking with it?
It seems so. Institutional ownership is reported as very high, somewhere between 70% and maybe even over 94% of the available shares, depending on the source.
So the big funds own most of the company. Are they buying or selling lately?
Over the last 12 months, the data shows a net inflow from institutional investors. About $10.9 billion came in versus about $7 billion flowing out.
So more big money coming in than going out, even with the recent wobbles.
Correct. It suggests that, on balance, the large, sophisticated investors are looking past the current gap losses and the scary capex numbers.
What are they seeing instead?
They seem to be buying into the narrative that this high spending on safety, infrastructure, and AI is essentially a necessary investment, maybe even a tax required, to make sure the Roblox ecosystem is the safest, most robust, and most attractive platform for the next billion users.
They're playing the long game.
It appears so. The market's short-term panic about the Q3 net loss and the 2026 margin warning seems to have overlooked the incredible operational execution and that gusher of free cash flow. The institutional money seems focused on that path to a billion users by 2030.
Okay, so let's try to wrap this up. It feels like Roblox is firing on all cylinders when it comes to growth. Users, bookings, engagement are all massive and ahead of schedule. That's generating record cash flow.
But that very success is forcing their hand. It requires these huge upfront investments in building out the platform, developing cutting-edge AI, and crucially, meeting intense regulatory demands for safety.
And those investments inevitably hit the official bottom line in the short term, leading to margin pressure and making the stock volatile. It's the classic growth stock dilemma.
It really is. Which leads us to the final thought, the core question for you, the listener, to ponder moving forward.
What's that?
Is all the spending, the safety measures, the rising DevEx payouts, the massive capex for infrastructure and AI, is it truly just a necessary tax? A temporary investment they have to make to ensure Roblox remains the dominant, safest, most appealing ecosystem for the long haul for those next billion users? Or does this relentlessly high and still accelerating cost structure signals something more permanent, a fundamental shift in the long-term profitability profile of this business, making those super bullish $180 or $300 price targets much harder, maybe even impossible to actually reach? That's the multi-billion-dollar question.
That is definitely something to think about. And on that note, if there are any companies you'd like to know more about, please leave a comment. Thank you for joining us on the Deep Dive. We'll catch you next time.